All right, hey guys, this is Mike again. Wanted to get a video out this afternoon highlighting our trades from earlier in the day. We did take a couple of trades off the table. We booked a few winners, so I wanted to walk you through why we took that action. I had some questions come in, people asking, hey, we only had partial profits, so why not hold on longer going for the bigger winners? So I wanted to walk you through the thought process and why I managed those trades the way that I did. Here today. So I am going to combine both the NASDAQ and the ETF services in this video, just for the sake of time. I'm not going to have time to get two separate videos out yet today. It's just busy with markets busy. There's just a lot to keep track of on our side. So if you're only a member of one or the other, I don't want you to be confused. I'm just going to cover our closing trades from earlier in the session. So before we get to those trades, let's talk about big picture here. We all know what's happened over the past few weeks, right? It was a nasty sell-off. In the midst of this selling here, I mean, the headlines couldn't have been any worse. And it felt like the world was coming to an end, right? Everything was coming to a crashing halt quickly. Well, we also know that the Fed stepped in, as well as the Treasury, and they basically threw a bazooka at this market and have been throwing, trillions of dollars around trying to get this market to stabilize and head to the upside. And that's started to kick in. It's been a very strong week. It's been an impressive 3.5-day rally here. No doubt about it. We have gone from a low to start the week down around 218-ish to the close here today all the way up at 261. I mean, that's a phenomenal move. We're seeing things happen that are very unusual, highly unusual. What used to take a couple of weeks, potentially a couple of months, is now happening in a few hours, few days. I mean, it's really phenomenal what we've seen. Now, it leaves us in a situation where we have gone from extremely oversold market-wide to now we're looking at some stocks that are very extended on the upside in the near term. You take a look at Boeing. Boeing traded down below $100 a share here on that nasty move to the downside, and just over the past 3-4 days, we've seen it recover to up around 180. When you see these types of moves, it becomes challenging because when you look at technicals, right, it looks like, hey, the market's breaking out here. It looks like we've got further to run on the upside. But when you take a look at some of these moves, you take a look at Boeing going from just under $100 to 180 in 3-4 days, it's extended. And we've got a lot of those types of patterns. In this market where nothing has changed news-wise, right? Other than, the stimulus plan getting passed. As far as the virus goes, we still have the uncertainty there. We still have the country here basically shut down and the economy coming to a screeching halt. None of that has changed. So in my opinion, we're going to continue to have an active market. I think we're going to get some pretty big moves back and forth. I don't think we're out of the woods yet. I don't think this market is going to continue to move higher indefinitely. We're going to have those swings back and forth, and we want to be cautious here. I don't think now is the time to swing for the fences. I think it's a market where you've got to temper your expectations and go for the smaller returns and go for the smaller winners and book those winners when you can. In this market, it's not uncommon to see 1,000-point swings in the Dow. Here we are again today, up 1,300 points. We could very well see bad headlines hit overnight. Going into the weekend, you could see a pretty nasty sell-off. And you don't want to give back all those profits. There'll come another time here in the near future where we can go for those bigger winners. But in this market, I'm really trying hard to manage risk and book those profits when we have them. So from a technical perspective, I could see one more push to the upside here going into Friday's session up to test the 20-period moving averages on the daily chart of SPY. You've got those green moving averages. That's both the simple and the exponential moving averages sitting right there. That would be an area of resistance that I would look to see, what price action does when we test those levels. The volume continues to be huge. We're seeing between 2 and 300 million shares trade on a daily basis. That's a very large volume for SPY. But here's where the concern kicks in. We've already talked about one of my concerns, just the extent of the move to the upside the last few days, but also the VIX. Volatility has contracted, but not in a huge way. If you were to take a look and see a move on SPY from 218 all the way up to 261 in 3.5 days, it would be logical to think that the VIX would get crushed during that stretch. It's lower, but we're still looking at a VIX rating above 61. The VIX was only down $2.78 here today. That's a very small move, showing that there's still a lot of uncertainty out there. There's skepticism whether this is a sustainable rally going forward. You've got this disconnect right now. You've got that tug of war going on between the market as a whole and volatility. One side is going to win out and one side is going to be wrong, right? Is this the VIX giving us a warning signal? Or are we going to continue to see equities plow their way higher and then the VIX continue to contract over the next week or two? Obviously, time will tell, but I'm just trying to show some of those warning signals. The VIX, I'm concerned there. Volume being so extreme. I don't see signs of the market, settling into that never-ending grind to the upside that we've seen over the past few years. I expect another leg to the downside to come over the next week or two. Not saying we're going to go back down to, to break the lows and make a new low on this move, but I do think the volatility, I think the range in this market is going to stay pretty active. Now, with that being said, just trying to lay the framework here for why we manage some of the trades the way that we did today. So let's take a look at a couple of those trades now. Let's start out with the NASDAQ trades that we closed out here first. Let's start out with Intel. To start the week, we had the markets making new lows. We had a lot of extremely oversold conditions, and we were taking a look at selling put spreads, and we did so on Intel to start the week, symbol INTC. And we came in and we used the April monthly options with 22 days left. We sold the 47.45 put spread, meaning we were selling the 47 put and buying the 45 put to make it a risk-defined trade. We collected 60 cents or $60 per spread on the trade. It only tied up $140 of capital per spread. So it was a very reasonable trade regardless of account size. Yes, you could have taken it with multiple spreads. That's perfectly fine. I wanted to give flexibility there, knowing that we have a pretty wide range of account sizes in our membership. Well, we sent out a closing alert here earlier today. We closed this one out for 30 cents. So we booked a $30 profit per spread. It gave us 50% of our maximum profit potential. Or in other words, it gave us a 22% return on our capital. So you're looking at this saying, why did we close it out? We've only been into the trade for, 3.5 days. What gives? Well, a couple things. Number one, a 22% return on my capital in 3 days. I'll take that every time. And looking at this trade, getting to a 50% of our max profit level in 3 days, the reason I took it off, number one, the market is extended. We're very, very extended in the near term. We can continue to grind our way higher, but at least in the near term, it's overdone. And you have to remember too, that when you're in an option position that only has 20 days left to expiration, everything starts to speed up. The time decay picks up, which helps us, but so too does the gamma. And the gamma of an option or a spread is essentially going to tell you how quickly those options are going to react to changes in stock price. The option prices become more sensitive to changes in stock price the closer you get to expiration. What that means is if this market continues to, let's say volatile, let's say it sells off over the next couple of days. If it does sell off, we can go from a profit to an immediate full loser. And I just wasn't willing to take that risk. Did I leave 30 cents on the table? Could I have made an additional 30 bucks? I could have, but in order to make that last $30, I would have had to hold longer, have that risk increase as we start to get closer to expiration. And I just wasn't looking to take that risk. Not in this market, not in this active market where it's very news driven, very headline driven right now. And the volatility is extreme because that VIX is still elevated. There's still fear out there. There's uncertainty. And I did not want to let this thing go from a really nice winner in a couple of days to a loser. Not to mention our portfolio as a whole has certainly been leaning to the bullish side. We had a lot of short put spreads on. I wanted to take advantage of this huge 3.5 day rally market wide and take the profits on a couple of these trades and reduce our exposure on the upside. I think that was the prudent thing to do, just given the extent of the move to the upside the last 3 days. So it was, again, a $30 profit per spread. If you took it with $500 of risk, like we talk about doing, and we actually kept it below $500 on this trade, it was a $90 winner if you took it with 3 spreads. So again, 22% return on our capital. The other one that we took off was on Starbucks. And on Starbucks, we actually sold the 55.52.5 put spread. So let me go ahead and load that trade up down at the bottom. And I know it looks a little funky here. Some of you have noticed this the last couple of weeks because this market has been so volatile. At the end of the day, the bid-ask prices on these options can get really wide. And I know it can make your P&L look a little funky, right? Both good and bad, right? You can see big profits or big losses overnight, and you're saying, what just happened there? Why is this position down money in a big way? It's because the bid-ask spreads get so wide at the end of the day. Once the market opens tomorrow morning, those spreads will tighten up, and you'll get a clearer picture of your actual P&L. So on Starbucks, we sold the 55 put and we bought the 52.5 put at the same time. We sold it for 68 cents. We bought it back for 27 cents here today. So it gave us a $41 profit per spread. Gave us a 23% return on our capital. So again, we are in that 50 to 75% range of our max profit. And everything I mentioned on Intel holds true on Starbucks. We've had a really nice 3-day rally. It's been huge. We wanted to take some risk off the table, take the profit while we have it, and then avoid any type of a big reversal that we get over the next day or two if it happens. So that's the big reason why I took a couple of those trades off. Now, let's talk about assignment here. For those of you that are part of the ETF service, there was a handful of you that got assigned on an XLE position that we had on. So let's talk briefly about getting assigned, because it can get intimidating. It's intimidating the first time you go through it, because when you get assigned stock, let's just say you had 3 spreads on and you got assigned on your short option, all of a sudden you might be long or short 300 shares of stock. And if you've got a small account size, you can potentially have a margin call, your broker saying, hey, we want more money. And it can be scary the first time through it. What I want to point out, if you get assigned, I shouldn't say if, it's when you get assigned, because as options traders, you're going to get assigned going forward. It's going to happen. It's part of trading. It doesn't happen all that often, but you want to know how to handle getting assigned. The first thing to remember is that with our system, we are always in a risk-defined trade. We always know what our maximum loss is right up front. And on XLE, those of you that got assigned, and let me go ahead and bring up that position that was the issue. It was the 43.71 put spread. That was the problem child for many of you that got assigned today. So we sold the 45.71 puts and we bought the 43.71 puts. Let me switch the strike there. So getting assigned on the short put, the 45.71 put is pretty far in the money. It's unusual to get assigned when those options still have 22 days left expiration. So I had some questions asking, is this common? With this much time left expiration, it's not. But in this market, there's a lot of fear. There's a lot of people panicking. There's a lot of unusual things going on, and it's certainly possible to get assigned early, like many of you faced on XLE today. So if the short option was assigned at 45.71, that left you long 100 shares of XLE stock at 45.71. 100 shares per spread. So if you sold it 3 times, you were long 100 or 300 shares of stock. The way that you can close the position out, the first thing that you can do after the market opens is you could go ahead and sell out of the 300 shares of stock and also sell out of your long option, the 43.71 put that you own. That would put you into a flat position. It would take your position off the table. The other option would be to exercise your long option. So you would exercise your right to sell 300 shares at 43.71. That would also flatten out your position. The reason why I will typically take step number 1 or option number 1 there is if you decide to exercise your long option, that's not going to be done until the end of the day. So there's a lot that can happen in the stock price throughout the day. So it's typically best to just go ahead and close out of your share of stock and also close out of your long option. Either way, it's not going to have an impact on your P&L. You're still going to know what your maximum loss is on the trade. And in this case, the maximum loss was $128 per spread. Okay, so the spread right now is trading for $2. So if you did not get assigned, I know there was a few of you that saw the comments in Slack and said, I wasn't assigned, what should I do? We're going to still hold the trade. There's still an outside chance here. We still have a couple of weeks left. In this crazy market, anything is possible. We still need a huge move higher on XLE. The odds are very much against this one recovering, but who knows? I mean, we may be able to take a smaller loss on it. So we're going to continue to hold it. And right now, the spread is trading for $2. That's our maximum loss. It can't get any worse here. So the reason I'm holding it is if it's already facing a max loss, there's no additional risk for me holding it. I might as well hold it and just hope for that outside chance of a big move higher. And worst case, if I'm assigned, like some of you were today, if I get assigned, it's just an extra step. I just have to close out of the position. I'm not looking at a larger loss if I get assigned. So don't get intimidated by it. There's always a way out of the position. That's a big reason why we always trade risk-defined positions. We want to know what our maximum loss is right up front. A couple of the closing trades on the ETF service. We closed out of 3 winning trades today. So let me pop those up. The first one is on GLD. And I want to say I've got this one saved in here. I do. So on GLD, we had sold the 139, 137 put spread. All right, so we sold the 139 put. We bought the 137 put looking for a move to the upside in gold. And that's exactly what has happened. So this was another one that I had some questions on with 22 days left. Why not keep the position on? We've got some additional profit potential here. Well, I closed it out today for 18 cents. It gave me a $47 profit per spread, $141 a profit if you're risking $500 per trade like we talk about. So it gave me a 35% return on my capital. I wanted to close it out again when you've got between 50 and 75% of your max profit. If you've got that showing in your account, I would rather book that profit, free up the capital for the next round of new trades instead of trying to hold on. You've only got 15 cents of profit potential left on this trade. In order to keep that 15 cents, I would have to hold for another 22 days. Anything can happen over the next 22 days, especially in this market. And I don't want to let this thing go from a winner to a loser because I'm holding too long, trying to get that last 15 cents. In my mind, it's better to book the profit, free up the capital for another fresh trade, instead of running the risk of having that gamma come back and hurt us the closer we get to expiration, as we talked about a few moments ago. So we close out of gold. Nice winner there earlier in the session. FXI, this is the Chinese ETF. We also closed out of a winner here. We sold a put spread. We sold a 32.30 put spread. We collected 52 cents initially to put this trade on. I closed it out earlier for 14 cents. It actually got down to around 7 cents mid-price. So just a really nice opportunity to take that 75% of max profit here today. So it was a $38 winner per spread, $114 winner if you're risking $500 per trade. So it gave us a 26% return on our capital. So this is another one. We had a nice move to the upside. We got to bounce higher. We're extended in the near term. For me, closing it out for 14 cents, it didn't make sense to hold an additional 22 days for only 14 cents of additional profit. It's just not worth the risk. Book the profit, free up the capital, move on to the next trade. So that was FXI. And then on XLK, let's see. I don't know if there it is. So XLK, we actually opened this one on Monday, and we actually went out to the May options that have 50 days left to expiration. So this one had a number of questions on. So we sold it initially for 55 cents earlier in the week, and we closed it out today for 28 cents. So we had right around 50% of our max profit booked today. It gave us a $27 profit, $81 profit, risking $500 per trade. So it was a little bit smaller return, 19% of return on our capital. This is another one where with 50 days left, I don't want to hold. I've already booked 50% of my max profit in 3 days. For me to book the second half of the profit, the last 50% of the profit, you got to hold another 50 days. Anything can happen during that time. So this is another one where I would rather book the profit, free up the capital for the next trade. And I had another question come in today. Do I just manage these trades according to the option P&L? Or do I look at the chart patterns as well? For me, I like to manage my positions according to the P&L of the actual option or spread. I think it's a better approach to take that route. I think it's best, and you're going to see the best returns doing that. It's not that I'm discounting the chart patterns. If you still, let's just take gold for example. We had a bullish trade on gold. We booked the partial profit. What if you're still bullish on GLD? What if you still like the position? Why not hold it? The chart pattern still confirms, and we still have a lot of impressive looking chart patterns after this move higher the last 3 days. If you are still bullish on gold, for example, I would still rather have you close out of our existing position. And if you want to open up another trade, that's perfectly fine. Maybe you go out to another expiration cycle farther out in time, or maybe you adjust your strike prices. I'm perfectly fine with that. I would just rather book the profit on the trade that we have. I think that is the smart thing to do. So I love to use chart patterns for entry. Like to use that for the actual initial trade ideas. But when it comes to trade management, I really do that more so on the P&L of the actual option position. And then also I factor in how many days are left to expiration on the option as well. So don't necessarily look at the chart patterns as much for trade management. It's more so for order entry is what I use the technicals for. So hopefully that answers some of the questions that came in here today. If you have any other questions on the trades closed out from today, let me know. Certainly willing to explain it in more detail. Still looking to get 1 or 2 new trades on here tomorrow. We'll see what the market does going into the end of the week. So when we take action on our side, we'll certainly get the alerts out to you right away. So I'll go ahead and wrap this video up here. Enjoy your evening, everybody. And I will be back with you guys here Friday as we wrap up the week.